Hello and welcome to Between the Lines, the podcast that dives deep into the stories redefining Asia-Pacific's reinsurance landscape. Recorded here in the newsroom of InsuranceAsia News in Hong Kong. I'm Mithun Varkey, Editor-in-Chief for InsuranceAsia News. In this episode, we'll discuss Nat Cats in Asia, Hong Kong's new captive, Australia's merger control regulation changes, and some broker moves in the region. We'll also bring you insights into the stories that the team is working on. Our special guest for this episode is fine art and specie specialist from Willis, Fion Ko. Fion will discuss Asia's exciting art market, what's driving the market, challenges and how climate change and sustainability is reshaping the market in the region.
Digital art and NFT, it's kind of like a new trend for the art market. I would say we're still digesting this new art form in terms of providing suitable fine art insurance solutions, because it's very different from the traditional artwork that we see or collectors acquire. So even the underwriters that I'm seeing, a lot of the underwriters are uncertain about what kind of products that they could provide to their clients on request. And then as a broker, we have to closely communicate and also do a lot of research and then to come up to establish a new set of solutions, how we may be able to help our clients to insure these digital art forms.
As usual, I'm joined by the InsuranceAsia News editorial team. I have with me today Deputy Editor Andrew Mullen.
Good to be back as always.
Senior Correspondent Aidan Gregory.
Good morning.
And reporter Roshan Nambiar.
Good to be here.
So let's start off. Andrew, can you give us a wrap-up, as usual, of the big NatCat events in the region?
Yeah, they've been a bit more closer to home recently. We're sitting here on Wednesday morning and we're under a Typhoon 1 signal here in Hong Kong. We're probably going to get the Typhoon 3 by Thursday. I would say we're braced for the impact, but we don't expect it to be anywhere near as bad as the black rainstorm we had last week. This saw 350 millimetres of rain drench the city by 2 p.m. on Tuesday last week. This was the highest daily rainfall for August since records began in 1884. The impact of that record-breaking rain, though, is not expected to be as widespread as the black rainstorm that occurred in 2023. Alex Tang from Sedgwick he spoke to our reporter Joanna Nguyen last week. The downpour was the second longest black rainstorm warning on record, after the highest level signal was in force for over 11 hours now. In comparison, in 2023, the signal was up for over 16 hours, and that led to gross claims filed of $191 million. So losses for the most recent black rain aren't going to be or not expected to be as bad, but for us who had to kind of survive it last week, it was still pretty bad. But and it's been part of a wider, I guess, wet period for the region.
Yeah, we did see rains in the mainland as well. I think Shenzhen and Guangdong were particularly affected. So was Beijing, which has been facing heavy rains for the past couple of weeks now.
Yeah, Shenzhen had pretty bad flooding on Tuesday last week as well. There was record-breaking rainfall there. This prompted the first citywide red rainstorm alert, which is a slightly different system in China, or mainland China, but it's still the top level of alert there. And then even into this week, as we said, we're here in Hong Kong waiting for the typhoon to come here. Japan has just gone through quite a wet period, and that resulted in 3 deaths due to various landslides and things. So yeah, the region's struggling right now, and it seems to be one NatCat event after the other.
That's right. It's been we've had quite a few events across North Asia this past few weeks. We also had a landslide in India, in northern India, in the Himalayas, which we don't know what the losses are from that, but it was quite a event as well. The videos were quite scary. Moving on from NatCats, we had some news from Hong Kong this week. Aidan, there's a new captive that's opening up in Hong Kong. Can you tell me a little bit more about it?
Yes, so Hong Kong has a new captive insurance company. In this case, it's a company called SIAC Motor, which is a state-owned car company that received approval this week from the Hong Kong Insurance Authority to set up a captive here in Hong Kong. It's the second Hong Kong-based captive to be approved by the regulator this year. After HSBC's Weifeng got the green light in May, there are now 6 captives in Hong Kong, 4 of them Chinese state-owned companies. The Hong Kong regulator has been very clear that, it sees the captives as, an important growth opportunity for Hong Kong, amid concern that the SAR has been losing ground recently to other financial centres such as Singapore.
Yeah, it clearly seems to be working. They've added 2 just in the last few months. So hopefully there's more captives coming to Hong Kong. One of the other stories that we've been tracking the past week was Mediterranean Shipping Company, the owner of MSC Elsa 3, which sank off India's southern coast earlier this year, has filed an admiralty suit in India seeking to limit their liability. So the ship was carrying 600-odd containers, including some hazardous cargo, completely sank as it left the Indian port of Vizhinjam. So far, there have been 7 lawsuits filed, including a $1 billion lawsuit by the Kerala government, which is a provincial government in the country. Now, MSC wants to limit the number of cases filed and the maximum liability that they'll end up paying. So the lawsuit seeks to limit the amount of potential claims to $14.2 million. The company is saying that if the liability is not capped, it has the potential to disrupt insurance and freight operations and drive up the prices of goods. What's quite also interesting is that Sri Lanka, which is hundreds of miles away from the wreck site, has also filed a lawsuit seeking compensation, reporting debris from the ship is washing up on its beaches. Andrew, you followed this incident when it originally happened and you had a few stories around it. Is there anything you can add to this?
Yeah, one of the interesting things is the Indian courts have already detained another MSC ship. This is for collateral against future claims. And just to recap, the event actually started on May 24th, before the ship sank a day later on the 25th, 13 nautical miles off the Kerala coast. Various containers have already washed ashore. As you mentioned, there was some hazardous material on board, and I believe the cleanup of that's going to take some time. In terms of insurers, North Standard, UK P&I Club, and the Steamship Mutual are listed as the P&I insurers, and we believe that North Standard is the claims leader. This is what a club source previously told us. It's a case of watching the space with this, and just a reminder, there was another ship had an incident off the Kerala coast around the same time. This was the Singapore-flagged Wanhai 503. That caught fire, and that was actually towed further offshore. The claims and cleanup is still going on around that as well, so we'll keep an eye on that one also.
Seems like it's busy time for maritime lawyers in India. The last week we had a couple of interesting people moves, especially in the broking space. Just to quickly recap. So Brit Specialty, which is the international specialty broking arm of American giant Brown & Brown, appointed Abhishek Chajjar as Chief Executive Officer for Asia. Now, this is quite interesting because, Brown & Brown, despite being a massive broker, had no presence in Asia Pacific. They entered the region with the acquisition of Kentro Capital, which gave them a foothold in Hong Kong, called a broker called Capstone. And then last year, they acquired a Singaporean broker called Aecon. So they're 2 brokers as part of Brit Specialty, and they were both operating quite independently in the 2 hubs of Singapore and Hong Kong. But this new appointment sort of indicates that probably Brit Specialty has a bigger plan for Asia, and that shouldn't be surprising. We've seen quite a few new entrants in the specialty broking space, so I think that'll be quite interesting to watch. Well, as I mentioned about Capstone, we had a story last week about one of the original founders of Capstone, Dan Dibden. He's actually left Capstone to launch a broker of his own. He's calling it Fraction. So Fraction's based in Hong Kong. So Capstone was always good at the strong financial lines, and especially in the digital space. So Dan was leading the digital crypto insurance broking. So Dan's carved out to deal with Capstone, where he'll take the digital assets business outside and he'll run that as Fraction, so leaving Capstone. So I think that'll be quite interesting to see how all that moves play out, especially for Bridge and Brown & Brown. Talking about brokers, we saw quite a few acquisitions in the region last week. Andrew, you were across the deals in Australia. What can you tell us?
Yeah, so this is Gallagher continuing to expand in New Zealand as well as Australia. They first acquired New South Wales-based MAC Insurance Services, a commercial insurance brokerage specialising in the agricultural sector. That was Gallagher's second acquisition in Australia this year after it acquired Tressida Insurance Brokers, which had offices in Victoria and Queensland, and they did this in April. And over in New Zealand, Gallagher acquired New Zealand-based broker insurer Taranaki as it continued to expand its footprint in that country also. And this was also its second acquisition in New Zealand this year after Gallagher acquired RMA General and its associated insurance broking businesses in March.
I mean, this is ongoing trend in Australia. We've seen quite a lot of broker consolidation, and that's quite interesting. And I want to bring in Aidan here because that's all going to change now with the new merger control regulation in Australia. And Aidan, you had a story on the new regime and what its impact would be on the insurance sector.
Indeed. So from last month, Australia's insurance industry now has to grapple with Canberra's tough new merger control regime. The Australian Treasury drafted laws towards the end of last year, essentially moving Australia from the previous regime, which was voluntary and run on similar lines to the UK. There aren't many countries around the world that use voluntary merger control regimes, but the UK and Australia, were very much outliers. But the new regime, which has come into force following approval from Parliament in December, is much tougher. It rewrites Australia's competition regulation along similar lines to the fearsome regulators of the European Commission and in the US. So from January 2026, all Australian companies embarking on an acquisition that trips these specific thresholds laid out in the law must notify the ACCC of, and they cannot complete these deals without approval from the ACCC, otherwise the transaction is void if that happens, and it's illegal, and they face penalties for doing so.
Some of these deals, obviously the broker deals, are quite small. How do you think those will be impacted? Do they all have to file, or is there a threshold under which you can just get an automatic approval?
So I spoke with various Australian legal sources, and the consensus is that, well, firstly, these are tough new rules, and it's the ACCC is going to be much more powerful going forward. They'll be able to block takeovers much earlier in the process than they could before, when they had to take companies to court to stop anti-competitive transactions from happening. The second consensus is that the transaction thresholds are very low in terms of revenue and connection to Australia. I think the revenue threshold is only 250 million Australian dollars, which isn't really that high, especially for insurance companies. So a lot of the M&A that we've seen in the insurance industry in Australia has been relatively small, and it's been skewed to small and mid cap deals, like the kind of deals that Gallagher has been doing recently. And under the new rules, all of these companies are going to have to notify the ACCC of what they're doing, even if there isn't any kind of real anti-competitive element to the deals, but they're still all going to have to notify.
So does that also mean that some of these multinational global deals where companies have a presence, the big insurers with a foothold in Australia, will they have to file with the Australian ACCC for an approval? So is that an additional compliance burden for global deals?
Yes, it is. So even for, Australia's big insurers, or any international insurer that has a meaningful connection to Australia, they're still going to have to notify under the new regime.
That's a massive change and will impact deals. Do you think we'll see a flurry of deals to sort of preempt that deadline in the next 6 months?
So from July, companies can start using the new rules. And indeed, this week we had the very first ACCC notification under the new regime by Kongsberg. It's a Norwegian aerospace company, with significant defence assets in Australia. And they've become the first corporate to notify the ACCC of a merger this week. They're acquiring some additional leasing land in Newcastle Airport in New South Wales for their defence operations, and they've become the first corporate to notify. But companies can still use the old rules up until October, so they don't have long. And I think the advice from the lawyers is, it's generally best to just start using the new rules now, so that they become embedded in compliance processes within companies. And it could potentially have an impact. We could see a skew of M&A transactions launched before the end of the year, particularly by smaller firms looking to sort of avoid these tough new rules. But they can only do that from October, and then from October onwards, they're just given the timelines for executing mergers. From October onwards, they're going to have to use the new rules.
I'm looking forward to the results announcements from Steadfast and AUB, who've been the most active acquirers in the market. I guess they might have some insights into what their plans are and how this new regulation will impact their strategy in the region.
There's still a very strong logic for consolidation of insurers and brokers in Australia, and market sources don't expect it to go away. It's just going to become more difficult and expensive, particularly with the filing fees under the new regime. They're pretty hefty, especially if your deal proceeds to a phase 2 merger investigation by the ACCC. It's worth also mentioning that, smaller firms can apply for exemptions from the new rules. And smaller firms are also exempt from the fees, but that's only for the very smallest companies. And, larger, small cap and mid cap insurers, will find themselves captured by the new regime and its associated filing fees and approval processes.
What is ACCC's response to these criticisms from the market?
The ACCC, enforces the laws that are set by the Australian Treasury and by the Australian Parliament. The Australian government has said that the new merger regime will enhance competitiveness in Australia by giving the ACCC greater powers to block takeovers that undermine competition in Australia. And Australia, is quite famous for, having very, very highly concentrated sectors, particularly the country's banks and insurers and supermarkets as well is very notorious for just being very, very concentrated. The supermarket industry in Australia is effectively a duopoly. And, these industries have repeatedly found themselves kind of in the crosshairs of the public and the government. And, the Australian government was under quite a lot of pressure to do something about competition. It was an issue in the Australian election. You had the leader of the Liberal Party promising to, break up the country's biggest insurers. And it's a politically very sensitive topic in an economy where consumers have faced, rapidly rising prices since 2022, and you have many, many concentrated industries and lots of M&A.
That's quite interesting, Aidan. We'll keep watching that. Let's talk about the stories that we're working on this week. Roshan, what's keeping you busy?
So I've been looking into the W&I space in APAC. So we've reached out to some underwriters and MGAs such as Euclid, Ryan Transitional Risk, and Fusion Insure with some questions on what the trend is going forward.
So what's the outlook for the market?
So the outlook for the W&I market is that it should gradually recover in 2025 as it's driven by the stabilizing interest rates and the release of pent-up private equity capital. And notably, there's also a demand for WI coverage in markets like Japan and China.
Interesting. We'll look forward to that story. Aidan, what are you working on?
So I'm looking at the outlook for insurance M&A as we head into the final quarter of 2025 and into early 2026. It's been a bumpy environment for deal making over the last 9 months. After the US election, there was a wave of optimism among investment banks that Trump reoccupying the White House would lead to a wave of deal making and fees. However, in April, a lot of those hopes were dashed when Trump came out and announced sweeping tariffs on all of the US trading partners, which provoked a global equity market sell-off at the time. In the months since, a lot of these tariffs have been walked back, particularly as the US has been doing bilateral deals with each of its key trading partners, and the stock market has rallied. So the S&P 500 hit a new high earlier this week. So, things are suddenly looking a lot rosy again for investment banking and deal making. And obviously, within the lens of the insurance industry, that's potentially going to lead to, pickup of transactions. So it has been a very quiet year for insurance M&A, particularly on the carrier side. There's been a lot going on the broking side, but we haven't really seen very much M&A between carriers in any region, really. Particularly Asia Pacific, but also Europe.
True, and all the additional cash that these insurers are making with the stellar results that they've been reporting, we should expect some deals to happen soon.
Yes, well, a more stable geopolitical climate, generally lends itself towards CEOs and CFOs being able to make, bigger, bolder financial decisions, such as launching takeovers.
I'm working on a worker compensation story. Generally just talking to the market, talking to underwriters and brokers about the trends in the worker employee compensation space. Obviously we know it went through a bit of a period during COVID when claims were very low because obviously people weren't working as much, I think. But the trends are claims seems to be bouncing back, and we're back in the pre-COVID days in terms of pricing, in terms of claims. There's apparently a lot of new capacity coming into the market in Asia. especially, for Asia where, outside of motor, I think worker compensation, employee compensation books are some of the biggest casualty books in the region. So it'll be interesting to see what's happening in that market. Sounds like a lot going on. Let's wrap up this meeting. Thank you, everyone.
Thanks, Mullen.
Thanks a lot.
Thank you.
I'm joined today by Fion Ko, who is Associate Director for Asia at Willis for Fine Art, Jewelry and Specie. Fion has had a long career as an art curator and gallery administrator. Will talk to us about the Asian art market, the opportunities for insurers and challenges that the industry is facing. It's a great conversation about the Asian art market, the opportunities for insurers, and the challenges of climate change, sustainability, and so on. I'm not much of an art collector, but I can assure you this is a really interesting conversation and a really interesting aspect of the insurance market. So have a listen. Hello, Fion. Thank you very much and welcome to Between the Lines. To start off, could you tell us, you've got an interesting journey in your career. Could you tell us how you got into fine art and specie and how you ended up in insurance?
Well, thank you, Mithun, for having me on the podcast today. I joined Willis last November as the fine art broker, and is an exciting new chapter in my career. This new role allows me to contribute to the art world in a completely different way, transitioning from someone who demanded fine art insurance and now to a professional who consults clients on their insurance needs has been incredibly rewarding and interesting. So I've been working for more than 10 years in the art industry. I worked in galleries in Hong Kong and Taipei, and my last position was with an art foundation, which is an NGO, where I had the opportunity to collaborate with global museums and art institutions to create art programs and curate exhibitions for the public. And I also practiced as an artist during my gallery days for some years. I used to be in the position of a client, and my background and my previous experience has helped me a lot when I'm now consulting different clients on their insurance needs.
Quite a journey from being an artist yourself and working on the client side to transitioning to becoming a risk consultant and an insurance broker. So I'll tap into your background in art. I just want to broadly understand how the fine art market has evolved in the past few years, especially, we saw quite a transition during COVID, and since then the market's gone through sort of a transition. Just trying to understand what are the broad trends that has evolved in the past few years in the broader art world.
I would say during COVID-19, there were significantly fewer or no exhibitions at galleries and museums, and social interactions were limited. I think this situation prompted the art market to engage more with local artists at the time, as collaborating with international artists became challenging. And that's also one of the reasons for a growing trend towards investing in emerging artists, from what I have observed in Hong Kong in particular. And collectors are also giving more attention to younger artists who may not be so established, and they are seeking unique pieces. Post-COVID, I would say collectors adopted a more conservative approach, and it took time for the art scene to regain its vibrancy. However, I can confidently say that things have returned to normal now, and people are hungry for art events and exhibitions, which has led to a flourishing art market over the last 2 years. If you look at Art Basel in Hong Kong and other major art fairs in Asia, you can tell that collectors from around the world will come to Asia and participate in these art events.
And how does that sort of translate from an investment perspective? Especially in Asia Pacific, are you seeing any specific trends in sort of art investment and art buyers' behavior in the recent years?
I would say the high net worth collectors, there may be some people thinking that seeing sales declining in the global art market, but I believe the luxury market has its resilience, and especially high net worth collectors continue to invest in fine art and luxury items as stable assets, even during economic challenges, which sustains demand for fine art and species insurance products. And I remain optimistic in the region in Hong Kong and Asia. In Hong Kong, for example, auction houses such as Christie's and Sotheby's have opened new offices in the central area of Hong Kong, where Phillips has established their regional headquarters set up at the West Kowloon district right next to the Empress Museum. This reflects a growing appetite for collecting luxury valuable and remain confident to nurture the younger generations of collectors as well.
Right. So there's been a rebalancing, but how does that sort of impact demand and pricing for fine art and specie insurance in the region?
I think we're currently in a rather soft market at the moment, which has created more competition, witnessing an increased demand for the fine art and specie cover in Asia. At the same time, we're seeing many new players entering the fine art insurance market, particularly in key locations like Hong Kong and Singapore. Leading insurers are expanding their teams and capabilities to focus on fine art coverage. And this competition also means that there will be more favorable terms for collectors, including potentially lower premiums and enhanced coverage options.
In terms of products that you see demand for in the region, what sort of insurance products are your clients buying?
But the fine art and specie insurance market is essential for protecting valuable assets such as fine art, jewelry, or species. That includes bullion, or banknotes as well. Given that there are limited markets for insuring this risk due to the unique nature of these assets, often requiring very high limits and operational flexibility. Take fine art insurance as an example. Fine art insurance typically requires a tailored approach, covering all risk of physical loss or damage for individual masterpieces and entire collections. And we collaborate with specialist fine art insurers to offer customized insurance solutions to private collectors, dealers and galleries, auction houses, fine art shippers and packers, and global museums. And there is a growing demand for broader coverage that aligns with clients' specific needs, such as framing, reframing, restoration, and conservation, which are often excluded from standard fine art policies.
And what's the sort of buyer profile? Is it typically galleries or individual buyers? What is the sort of market like?
It was never like just collectors or galleries. It's usually private collectors we have, which are the majority of our clients are private collectors from around the world, and international galleries, auction houses, and shippers and packers, which they helped collectors to transport the works, and also global museums who have regular exhibitions where they will also loan artworks from other museums, which each type of clients will require very different and very tailored fine art insurance to cover all risk as well as their transits.
Interesting. So what are the sort of unique risks associated with fine art in the region? There's quite a lot of conversations about climate change and, geopolitical risks, etc. What are the biggest risks that insurers face?
In the APAC region, the primary challenge lies in environmental risk, such as potential damage from floods, typhoons, earthquakes, and whether temperature and humidity are properly maintained at the risk locations. These natural disasters can cause significant damage to artworks. Another significant risk, I would say, is the logistics of transporting art, especially over long distances or through regions with inadequate infrastructure pose risk of damage or loss.
Are there any specific claims trends in the APAC fine art market in recent years?
We have not identified any significant trends in claims related to fine art and species at the time, but we believe in the importance of emphasizing preventative measures and risk management strategies to minimize the likelihood of claims. And what we do is maintain close communication with our clients and providing them with the guidance of best practices for storage, transportation, and overall care of their artworks. We believe this proactive approach would help to reduce risk and ensure that their assets are well protected. But in Asia, we very often advise our clients to be more mindful, say, potential damage from floods and water in Hong Kong specifically. And for the clients who have artworks storing in Taiwan or Japan, then the earthquakes may become an issue that needs more attention. Even within the APAC region, the primary risk and challenge would vary.
It's natural catastrophes that are the primary risk factor for fine art and species.
Yeah, within the region, this would be the primary risk that we identified.
How is sustainability influencing the fine art market, and what sort of initiatives are being taken to promote eco-friendly practices?
I believe sustainability is increasingly shaping the fine art market, prompting artists, galleries, and institutions to adopt eco-friendly practices. I saw that artists are opting for sustainable materials, such as recycled canvases or eco-friendly paint. They also will think a bit more about the packaging in order to reduce the environmental impact. Galleries and museums are also rethinking exhibition designs to minimize waste, or maybe using reusable materials and energy-efficient lighting. Transportation and logistics in the art world are also paying more attention on sustainability. Many museums and organizations are optimizing the movement of art to reduce carbon footprints, such as prioritizing sea transit over air freight. A notable example is a local museum that we work with has proactively adopted this approach as one of its green goals. And by implementing more eco-friendly logistics practices, they not only minimize their environmental impact, but also set an example, for responsible art transportation in the industry as well.
Are there any specific markets within APAC that you think are quite exciting at the moment in terms of art and demand for art insurance?
I would say Korea, as we have been seeing a really fast growing trend and demand for digital arts.
Mm-hmm.
Yeah, which we are seeing many exhibitions and many institutions are investing a lot of time and money in developing this area. But then digital arts, it's an NFT, of course. Digital art and NFT, it's kind of like a new trend for the art market. So I would say we're still digesting this new art form in terms of providing suitable fine art insurance solutions, because it's very different from the traditional artwork that we see or collectors acquire. So even the underwriters that I'm seeing, a lot of the underwriters are uncertain about what kind of products that they could provide to their clients on request. And then as a broker, we have to closely communicate and also do a lot of research and then to come up to establish a new set of solutions, how we may be able to help our clients to insure these digital art forms.
Obviously, digital art does not have physical risks that tends to be the reason for the claims, but does it open up to new risks like cyber, for example?
Yeah, but I would say most of the time that it's because digital artworks always comes with digital equipment or devices. So there's still a very blur line when underwriters or us trying to define whether we should see it as a property or whether it's a fine art, whether it's an artwork. So there's a very thin line of how to define it. And I think we're still on the way of working on it, because honestly, I would say a lot of underwriters would hesitate of how to offer proper wordings, proper coverage to cover these works.
Fion, thank you very much for your time, and really enjoyed having this conversation. And it's interesting to understand the sort of niche world of fine art and how that's sort of evolving in these times. Thank you very much.
Thank you very much for having me. Thanks a lot.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you are subscribed to our daily and weekly newsletters, which are delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.